our next guest saying to embrace for the overall market to see some volatility here in 2025 with the potential for no Fed rate cuts. Joining us now, I want to bring in Noel Dixon, a State Street Global Markets senior macro strategist. So here we are, Noel. We're seeing some, I don't know if you want to call it skittishness within the market, but we are seeing what have been a market leader, obviously NVIDIA, under a decent amount of pressure. Here we are ahead of the Fed decision tomorrow. What's the number one thing that investors need to keep in mind between now and heading into the new year?
Yeah, I think the major thing is that the Fed is going to have to probably pump the brakes. Although they're going to cut tomorrow, their forward guidance is going to have to get adjusted. So they're probably going to have to take out a cut or possibly two cuts from their 2025 projection. Also, the long-term terminal rate, I think, is also going to have to increase. So they're up against an economy where economic surprises continue to pick up. We saw it again today with retail sales. So we're going to have a more cautious Fed, I think, coming into the beginning stages of 2025, and that could introduce some levels of volatility.
How do you imagine the Fed is thinking about the consumer and best trying to really describe or encapsulate the mindset of the consumer going into next year, where it certainly is seeming like the setup is that there are going to be a larger range of inputs that consumers even have to evaluate, whether that be tariffs that could be talked about and then the activation of those that's still up in the air. But all of these things considered, how do you think the Fed is really trying to best describe the consumer going into 2025?
Yeah, so the Fed is dealing with a bifurcated consumer. So in other words, you have maybe the bottom two quintile of income earners really continuing to struggle. And they're going to be introduced potentially with higher prices as a result of tariffs coming on board. But then on the other end of the spectrum, you have, affluent consumers who are asset owners. They're benefiting from a pickup in the stock market, higher home prices. They have, their wages are, they have pretty decent income, so they have real wages. So you have this bifurcated sort of K-shaped economy, if you will, that the Fed's really going to have to be cautious in terms of navigating.
Well, you mentioned the fact that we could see some more volatility if the Fed doesn't cut as many times as maybe the market is anticipating. How big of a risk, or what risk then does that introduce to the equity markets?
Yeah, so I think the equity markets by any standard is overvalued at this moment. I think you're going to have to be really selective. If you just look at PEs, it's well above its trailing 5-year average. So I think, the economy, it's still strong, so that's going to be helpful. But the fact that there's sort of an unknown in terms of where the neutral rate is, whether or not we're seeing a stalling in the decline in goods prices, and whether we get a reacceleration in inflation, all of this stuff, I think, could lead to some profit taking, I think, in Q1.
Well, where do you think the neutral rate is?
So I think the neutral rate is actually closer to probably 4%. For a host of reasons. I think, obviously, I think productivity is higher, so there's more demand for credit. I think we're going to have a pickup in more safe assets, so higher treasury issuance. I think if we do get the immigration policy put forward, that also would put pressure, I think, on the labor market and on wages. So all things equal, you'll have to have a higher restrictive rate. So collectively, I think that gets us closer to 4% for the neutral rate.
Given the post-election run-up that we've seen, it seems like the markets are factoring in a lot, even with the Fed potentially being not prioritized as high from investors' mindset as they were going into the election, as they were especially kicking off their cutting cycle. All that considered, how far out do you think the markets are looking right now, and what could potentially disappoint this market?
Yeah, so I think the market is, I think it's a forward-looking mechanism, but I think that forward-looking component is a little shorter. So I think they're looking maybe 3 months out. At the moment, it's, kind of focused on the benefits, the deregulation, the potential tax cuts through reconciliation. So it's focused on the positives, but I think, when we get into next year, past inauguration, I think the reality is going to start to creep in. You're going to start to see if we do get the tariff policy, the markets then will have to price in the next 3 months, which, it's either going to lead to higher consumer prices or it's going to put a squeeze on corporate margins. So I think that's where you start to get the volatility. For now, it's looking at, sort of the medium term, the positives, but when we get into Q1 and it looks forward from that point onward, then you have to start to factor in some of the more negative components.